In the United States, intelligence is a strong predictor of high income, but it is a poor predictor of total net worth. This address examines the structural and behavioral reasons why the smartest individuals often make the most catastrophic financial errors. We analyze the intelligence trap, where logical problem solving fails in the face of probabilistic market systems, when high earners rely on their own judgment rather than a rule-based architecture. They introduce behavioral risk that the modern financial system is designed to exploit. In this briefing, we will break down Number 1, the correlation gap. Why IQ predicts your salary but fails to predict your balance sheet. Number 2, the confidence penalty. How conviction reduces diversification and prevents course correction. Number 3, the engineered environment. How brokerages and media amplify fear and greed to profit from your activity. The architectural solution. Moving from manual decision-making to automated capital allocation. And number 5, rule-based rebalancing, using mathematics to force the sell high, buy low protocol. The goal is to stop being a trader and start being a designer. Subscribe to join our next deep dive into the specific software and structural protocols that the top 1% use to automate their wealth creation. High IQ individuals fail because they rely on their own real-time judgment. The solution is to delete the judgment and replace it with an architecture. It is not enough to understand that your intelligence is a trap. You must build an architecture that makes your intelligence irrelevant to your success. In the United States, the elite do not wake up and decide what to do, what to buy, or what to sell. They operate within a rule-based system that automates the 3 most critical pillars of wealth. First, you must implement automated capital allocation. You must remove the human element from the act of saving. By the time your paycheck hits your primary account, a predetermined percentage should already be diverted into your compounding vehicles. According to data from the Consumer Financial Protection Bureau, individuals who utilize automated savings plans are nearly twice as likely to maintain long-term financial stability than those who rely on manual transfers. You do not decide to save. The system must save for you. Second, you must utilize rule-based rebalancing. Smart people lose money because they become emotionally attached to winning stocks or fearful of losing ones. A structural solution is to set hard mathematical triggers. If an asset class grows beyond your target allocation, the system sells a portion and buys the underperforming assets. This forces you to do the 2 hardest things in finance: sell high and buy low. You are no longer predicting the market, you are mathematically correcting your position. Number 3, you must adopt low-friction structural design. Every decision you have to make is an opportunity for a behavioral error. By reducing the number of logins, apps, and brokerages accounts you manage, you reduce the surface area for mistakes. And I have said this before as well, in 2026, the most successful investors are those who have the fewest interactions with their portfolios. Success is a result of your system design, not your daily brilliance. Wealth is not built through constant action. It is built through the strategic absence of action. You stop being a trader and start being a designer. You stop trying to outsmart the market and start building a fortress that the market cannot penetrate. Now lend me your ears if you really want to change your life for good. To build a profit out of thin air, you must first master arbitrage and tax shielding. As of April 2026, the standard deduction has risen to $16,100 for individuals and $32,200 for married couples, providing a massive window to wash your capital gains. If you are a low-earning American, you can strategically sell appreciated assets up to $98,900 income threshold to lock in a 0% capital gains rate, effectively resetting your cost basis to 0 for free. Furthermore, you should immediately pivot your dead cash into a high-yield cash management. With high-yield savings accounts currently offering up to 5% APY and Treasury 1 bonds carrying a fixed rate component of 0.90 plus inflation, keeping money in a standard 0.01% checking account is a literal theft of your future self. By simply moving your emergency fund to a top-tier digital bank like Varo or Sophie, you are creating a passive income stream that requires zero labor. The second tactical move is the HSA investment pivot. If you are a salaried employee with a high deductible health plan, the health savings account is the only triple tax advantage vehicle in the US system. For 2026, the contribution limits have increased to $4,400 for individuals and $8,750 for families. Most people use this as a spending account for doctor visits, which is a catastrophic mistake. Instead, pay for your current medical expenses out of your pocket, save the receipts, and invest the HSA capital into a low-cost S&P 500 index fund. Because there is no time limit on when you can reimburse yourself. You are allowing that capital to compound tax-free for decades. You can then withdraw that money 20 years from now, tax-free, by matching it against those old receipts. This effectively turns a medical bill into a high-performing retirement asset. Finally, you must implement strategic debt compaction. In a high-rate environment, carrying a 24% credit card balance while trying to invest at 8% is mathematical suicide. To save yourself, you must move from high-interest revolving debt to structured, low-interest consolidation. Utilize 2026 compliant fintech platforms like Upgrade or Sophie to collapse multiple high-interest cards into a single personal loan with a fixed APR. This move alone can create hundreds of dollars of monthly cash flow out of thin air by slashing your interest drag by half. If you are homeless or low earning, your primary profit comes from the earned income tax credit, which in 2026 remains the most powerful wealth transfer tool for the working class. Filing correctly and claiming every available credit is not just a tax chore. It is your seed capital for the next year. The closing of this gap is not a matter of luck or sheer labor, but a matter of structural positioning. In the United States, you are either a victim of a pricing mechanism or a beneficiary of the compounding system. You cannot work your way across a structural divide that was designed to be calculated across. The rules of the 2026 economy are transparent for those willing to look, and they prioritize the allocator over the earner every single time. The choice to remain an observer of this system is the most expensive decision you will ever make. It is the silent tax of ignorance that costs more than any IRS filing. By taking your intelligence out of the emotional loop and replacing it with a rigorous rule-based architecture, you stop being a passenger in your own financial life. You start designing the outcomes that others only dream of. Success in this environment is not about being the smartest person in the room. It is about having the most disciplined system in the market. In our next address, we will move from the diagnosis of the problem to the exact execution of the solution. We will provide the specific blueprints for the automated structures that the top 1% use to stay ahead of inflation and taxation. If you truly understand the gravity of the shift we discussed today, then you have already taken the most difficult step towards real freedom. You have stopped asking why the system is unfair and started asking how to master it. I will keep posting only the ways that actually work on the ground for wealth creation. If not this, then some other discussion might help you. Please subscribe so we can grow together. And please take care of yourself.